Good morning. I'm Mehdi Sunderji and welcome to OETV. We are here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi.
So futures are definitely off to the races. We just had a favorable CPI report showing a slower rise in consumer prices, both on a month-over-month and year-over-year basis. You published on Sunday night, so obviously quite a lot's happened since then. Would you mind kicking us off as usual with your top down and maybe highlighting if anything today's move will change any of your thoughts?
Yeah, I can start out by saying that today's move will not change any of my thoughts whatsoever. The S&P was down 3.5% last week. It's probably up 3.5% with today's action. So it's basically a wash over the last, say 7 trading days. I would continue to argue that the primary trend of the S&P 500 is bearish at this point. And, market internals continue to give a mixed signal, but I would argue that the signal leans more bearish than bullish. We've seen a number of signals, and we're going to talk about this, that suggest that we were very, very near a major turning point. And I think today's spike up on this news may have put in what will likely prove to be a top. We had been looking at the December 1st top as being one potential. And, we had a range of upside to around today's high, actually 41.47, which is the Fibonacci 78.6% retracement of the August October decline. And so, that was the kind of the upper bound of our expected range. Whether we get slightly above that or not remains to be seen. But, at the end of the day, I would say that there's, a couple things to think about. Over the past year, we've seen rates rise 400 basis points, soon to be 450 basis points tomorrow. And the PE multiples come down around 4 multiples. So we're at around 22 times. Forward 12-month earnings at the beginning of the year were about 18 times today. I'd also point out that 2023 earnings estimates have been revised down from around 252 to, according to S&P Global, 227 as of Friday. And that's about a 10% revision to the downside. But if you look at a number of the major houses out there, strategists have actually revised their forward 12-month earnings estimate down something like 20%. We've seen estimates out there as low as 195, according to Deutsche Bank and Morgan Stanley. JP Morgan's at around 205, Bank of America's 200, UBS is 198. A number of others kind of fall in the same realm. And so, at the end of the day, it looks like some of the top strategists out there are expecting a fairly significant downgrade to earnings going forward. The consensus is not there yet. The consensus is close to $30 above kind of the midpoint of that range that I just described. And so, we think that the market has yet to really discount this decline in earnings. So with that, we continue to expect the market to chop into the year end, and we expect a significant rollover in the first quarter as, we think companies will begin to report, a reality check for 2023. They'll use it as an opportunity to bring expectations down, and we think the market will follow.
Understood. Definitely lots of revisions have been hitting the tape. You kicked off this week's report with a look at the Dow Jones and negative breadth divergence. Can you talk us through this?
Yeah, the Dow is a very liquid, very high quality dividend paying index of 30 stocks. It's an oddball index because it's price weighted. So, for example, United Health Group, which is a 500 handle stock, has the heaviest weight in the index. I think it's about 13% or so. Whereas if you compare it to the S&P, it's closer to around 2%. So, it's got this, it's more of a defensive index. And what we saw is the Dow has actually led all of the major averages up over 20% through last Friday's close. And, frankly, that suggests that there's been more of a defensive shift, right? that people are playing defense, going with these higher quality, very liquid names. But the Dow also has the distinction of being the only major average that actually took out the August highs, just fractionally, a couple percent higher. But at the end of the day, if we look at the New York Stock Exchange cumulative advanced decline line, the AD line didn't even come close to its August highs, and so that negative divergence suggests that breadth has been very, very narrow, and just by definition, the Dow being the leader confirms that.
Jeff, you touched on it in your opening statements, but where do you see confidence in a year-end rally?
Yeah, I think that the confidence has been waning. We saw this peak on December 1st. We'll probably we've made a new high today. The market hasn't opened yet, but in the futures. And, my suspicion is that the cash markets will confirm that futures rally in the next 20 minutes or so. And that will be the high for this leg of the advance. And so the question is, why is confidence waning? Well, as we look at the VIX index, the volatility index compared to the S&P, VIX is in the lower panel here. You can see that every time the VIX got above 34% and, sustainably so, it marked a tradable low in the S&P over the past 12 months. If we look at the opposite of that, in other words, the VIX kind of settling back down into around the 20% or high teens area, it has been very closely associated with prior market highs, tradable highs, right? And so we think that the pullback in the VIX down to just around 19% or so most recently, I believe it was around December 2nd, is very, very consistent with the recent high that we saw. It's possible today the VIX will make a lower low. We haven't seen that, but if it does, it'd be consistent with the high in the S&P. And so, these are signals to us that we're getting to a point where the market is poised for a trend reversal. The VIX has already moved back above its descending trend line, like it has the past 3 or 4 times. And it's also above its 21-day moving average as of last week's close. And so, those two factors give us at least some semblance of expectation that the VIX will likely begin to reverse from these levels. And with it, we expect the S&P to fall. Once the S&P breaks below the November lows, I think we'll begin to see a serious acceleration in the VIX. And ultimately, if the S&P makes a lower low, we should see a VIX spike up into the upper 30s, perhaps even in excess of 40%, a level we haven't seen print in around 2 years.
Jeff, let's get back to the S&P earnings side of things. You've been pretty on point with all of this since June, where you were saying that analysts had to bring some of their estimates down more in line. As you mentioned, they have started doing that. We are seeing some of these numbers come down. Do you think enough is being done, or is there still more to go?
Well, I think the point of showing this slide is that back in June, we revised our earnings estimates. Recall in 2021, we were way above the street consensus, and we were right on the mark. We hit it within $2. We were at 210, and we had published that 210 estimate in March when the street was at 165 or something. And so, the street came way up, and we hit our number. Our 2022 estimate at the time had been around 230. We had cut it to, I think, 219 in June. It looks like we're going to come into, I think we were at 229 in June. I think we're going to come in around 220 this year. So we had cut it in June to 198. So we thought, basically the street was way, way too high. It turns out we were too aggressive. Nominal GDP really helped bolster earnings this year. And, we're going to prove to be, we still have a fourth quarter to report, right? In fact, the third quarter isn't even completely reported. But I suspect street estimates will come in closer to, say, 220 for the year. And, we're probably going to be, maybe $20 too high. For next year, though, that's the issue. We had been at 193. The street's now at 227, down from 252 back in June. And the point is that, as I mentioned at the outset, a number of the big houses have been lowering their top-down forecast for S&P earnings this year or for next year down into the same realm that we had been forecasting since June. So, I think that what's happening basically is the street is coming in line with reality. Our key assumption had been that margins would mean revert. It's the most mean reverting series in finance. And we've seen a lot of evidence that analysts on the street are reducing their 2023 profit margin forecast down into the mid 12% from as high as 14%. We think it's going to fall short of 12%. We think we're going to be looking at something with an 11 handle for profit margins in 2023. And that's how we get to our 193 estimate. If we do see earnings come in, to kind of, from a consensus perspective down to where we are, I suspect it's going to be because operating margins, profit margins are coming in well below expectations. And I think the risk is to the downside there. So, that's kind of where we stand. 193 is our outlook. We're slightly below the low on the street right now.
193 is the magic number. Jeff, let's talk some technical, shall we? Let's have a look at the primary degree Elliott wave count.
Yeah, so we've got two working theories. The first one on the left side is our preferred count, and that count suggests that it's going to be a deeper decline initially. We've counted 5 waves down from the January high into the June low. We've counted that as primary wave 1 down of a 5-wave motive wave decline, which will ultimately be wave A of an ABC. We think that the August high represents primary wave 2, and then everything since that is part of primary wave 3 down. The October low is likely intermediate wave 1. The highs that will likely prove to be today could be intermediate wave 2. And as long as they hold below the August high, then this will remain our primary and preferred count. But the next move to the downside is going to be a doozy. It could carry the S&P 500 down into the mid 2000s. We've got a range of around 2750 to 2400 as kind of our target range should this preferred count play out. Now, the alternate count on the right-hand side suggests that, there is perhaps some potential that this is going to be a shallower initial decline. And so, we've counted that 5-wave move off the January high into the June low as wave A. And we're saying that instead of being a motive wave, we're going to trace out what would be a corrective wave. And a corrective wave moves in 3s. We label them A, B, C. And so the June low, we labeled primary wave A down. And the advance off the June low, we're calling intermediate wave A up. And the October low, we're labeling as intermediate wave B down of a B wave. And so we're in the midst of intermediate wave C up. And once that is complete, if this count is operative, it could carry as high as, say, 4365, which is the 618 retracement of the January-June decline. So that's our alternate count. Once that this current advance terminates, which we think should hold below that 4365 level, that would be primary wave B. And primary wave B will be followed by primary wave C down, which should carry the S&P down into the mid 2000s. We've got a hypothetical target of 2440, assuming our B wave high terminates inside of that 4365 level.
Jeff, just to clarify, first of all, what would invalidate this in your opinion? And also, by looking at your alternate count, it looks like we could exceed the August high, like marginally, and it would still be maintaining the count.
Yeah, so the alternate count basically would be invalidated if the market made a new all-time high. B waves can retrace up to 100%. of an A wave. And so that's just, RN Elliott's rule. And so the only thing that would invalidate the alternate count would be, my decision to change my mind or, basically a new high. But the preferred count is, very much intact at this point. The preferred count would remain intact unless we exceeded that August high of 43.25 and change. And so, we put the make or break at 43.26, a whole number, and we'll leave it there. If we did get above that 43.26, we'd move to the alt count. If we got materially above 43.65, we would have to be rethinking what's going on in the market. There's something wrong with our analysis, and we would likely go back to the drawing board. But we're far from that discussion at this point.
Understood. Thank you. And how about on a short-term visual?
Yeah, the short-term options are basically this. This is an intraday chart looking back 4 months, just around the August 16th high. And so we've counted 5 waves down into the October low, which gives us a lot of confidence that's intermediate wave 1 down. The advance since the October 13th low has been choppy and overlapping. Those are the typical characteristics of a counter trend advance. It's also been longer in duration than the August-October decline at this point. And so that also would suggest a counter trend advance. So what we've done is we've kind of come up with a couple of targets. The first target was the 618% retracement, which we got slightly through on December 1st. And, based on that, we had been looking at a double zigzag as being our primary interpretation of the advance, which would put it at intermediate wave 2 high. The decline off that appeared to be impulsive. It looks like it's falling short of impulsive at this point with today's rally. And that moves us to our alternate, which is kind of the magenta indications, those notations there. And that suggested that we could hit our stretch target, which was 41.18 to 41.47 in the cash market. 41.47 looks like where we'll be at the high end based on the futures today. And that comes in at the 786 retracement. 78.6 is the square root of 618, which is a Fibonacci retracement number that we had been looking at. And so, we'll fall into that range. The 41.18 level was a level where the W leg of this double zigzag would equal the Y leg. And so based on that, it gave us a pretty high confidence range if we exceeded the December 1st high, which looks like we're going to. So, I would suggest that the market will be peaking at or about today's high within, kind of striking distance of that 786% retracement today. And the next move should be down. It should be the peak of intermediate wave 2, and that'll be followed by intermediate wave 3 or primary wave 3, kind of the dreaded third of a third wave decline. And so we think it's good opportunity to sell as the bottom line.
How do market internals play into all this?
Well, market internals have really supported our view. If we're looking at the NYSE, which is on the left-hand side, it's a broad market of around 2,200 stocks. The rally on the NYSE has been has fallen well short of the counter trend advance that we saw in June, August. And so, you would expect the internals to, support that, or I'm sorry, I think I misspoke. The October rally off the October low was 19%. The rally off the June low was 14%. So you'd expect that stronger percentage gain to support stronger market internals when in fact they have not. The internals have fallen well short of what we saw in the June, August advance. The same is kind of true of the October advance. While the advance has actually been weaker, it's been about half what we saw off the June lows. The internals have been brutally, weak, and in fact, the advanced decline line continues to hold below its downtrend line. And so, we continue to view this as an indication that the rally off the October low is occurring at a lower degree of trend than the rally off the June low, which supports our preferred count on the Elliott wave analysis.
Understood. And you've looked at investor sentiment versus positioning before. How is this looking at this point?
Well, we're always trying to find some information that's not, headline news on CNBC, right? Everybody knows that the surveys have been very bearish. Everybody knows that investment managers have been surveyed. They're all underweight equities. Individual investors are as bearish as they've been since 2008. Professional newsletter writers are predominantly bearish, myself among them. And there's a reason for that, right? Because, the conditions are bearish. Well, the prevailing view is that that's a great contrarian, buy signal, right? When everybody's on one side of the ship, you should go to the other side because it's going to capsize. And so, the quote unquote savvy move would be to bet against the crowd, right? But, for the most part, when we look at strategists and portfolio managers that are running, hundreds of billions of dollars in assets under management, these aren't shoe-shine boys and cab drivers that are bullish. These are the best and the brightest on Wall Street, right? And they're bearish, not for unfounded reasons, but because, there's a lot of support to the argument. And so, we think that, we need to be a little bit deeper in our thinking than just looking at this kind of, cliche that's kind of worked off and on. It's got an okay record. But, what we found here is that the borrowed interest in shares of SPY, which is the S&P 500 ETF with the greatest depth and volume, has now weakened to a point where we haven't seen really since the market peaked in January. And so that suggests that there is not a lot of short interest in the S&P 500 outright. Now, more people are using options. It's showing up in that frame. But, our view is that this is just another piece of supporting evidence that suggests that, what was a tailwind for the market, a heavy short interest in SPY that would have to be covered, isn't necessarily, the same as it was throughout the balance of the year. In fact, that tailwind, I think, is no longer, in favor of the bull case, put it that way.
And looking at some of the sectors that have outperformed over the last several weeks, you have highlighted that there's been a bit of a transition, or there's been more upside in some of the defensive sectors. How are you seeing things at the moment?
Yeah, this misstates that this says month to date. It's actually last week's performance, so I apologize for the typo. But what we saw last week, which, again, the S&P was down 3.5%, so you'd expect a more defensive tack in the market. And that's exactly what we saw. Staples, healthcare, utilities led, energy, tech, discretionary. These were all underperformers. Those were the areas that you would expect to do well when the market's doing well. But, if we're in a new bull market, we would not expect, tech and discretionary to be faltering the way they are. And discretionary is actually the worst performing sector in the S&P 500 off the October lows to date. So, that stands out in my mind as being a reason to be concerned or to question whether or not this is a sustainable rally, just from a bottom-up perspective. The fact that energy is tanking the way it has been also does suggest that we're not seeing aggregate demand for energy, which would be indicative of a recovering economy, supportive of that thesis. In fact, there's a lot of reasons that we can point to. There was a lot of financial support for energy that has been, basically falling off, as CTAs and whatnot liquidate their long energy futures positions. And then, we also have the SPR drain that's been a headwind. And, that suggests to us that, even though we are production constrained, in other words, in the US, we are not set up to produce what we are going to consume in the next, say, 12 to 24 months. We can still import what we need to consume in this market. And, there is an abundance of oil out there coming from, nefarious sources, right? Iran, Venezuela, Russia, even though there's a new cap on Russian oil. We'll see how that works out. It's a paperwork issue more than anything, but it seems to me that there's plenty of oil out there if you really want to get it, and that's what's impacting energy. We think those dynamics could tighten up going forward. We continue to rank energy highly. Its relative strength profile, based on the performance year to date, has been exceptionally strong. That has not broken as of the last time we published on the subject, which was at the beginning of the month. We'll see how things change at the end of the year. If it has broken, we'll change our opinion. But at this point, we continue to think energy's a better long here than short.
Understood. And that rolls us nicely into how to make some money in this market. So what are we thinking for the week?
Well, yeah, there's an idea that bubbled up in our work, and it has been strong over the last several weeks and months, and it's been on our radar screen, and that's Celsius Holdings, not to be confused with the crypto exchange Celsius. This is the beverage company, and so Celsius Holdings, they received a major investment from PepsiCo recently, and that's really bolstered, their energy drink franchise. The stock went out around, or it looks like it's opening today around $120 in pre-market. The breakout above 118 is what caught our attention. That has resolved about a year-long classic pattern-based formation of the cup and handle variety. It counts initially to 142, but longer term to 198. That's a lot of upside potential for this high growth name that just received an equity investment from a major player in the space, which bodes a lot of confidence from competitors out there. Correct. And so we think we want to be long the stock above 118, looking for that 142 to 198 rise. We want to protect our capital with a stop loss at 91. That sets up a nice 3-to-1 positive risk skew to our out year target.
Jeff, I can say quite comfortably that the Celsius crypto firm chart would not look quite like this, but not berating the crypto world at all.
They would have thought I got it upside down or something.
Maybe. And what about on the short side?
On the short side, our thesis has been, and this is again plays into something we've been talking about in our notes in the past, and that is you can't really get a bull market without participation from the banks. And the banks have really been flagging, and none worse than Zions Bank Corp, which is a Utah-based bank, kind of a regional lender, if you will. The stock went out, I think, around $49. A break below 48 would actually resolve this pattern, which is a classic pattern top formation of the head and shoulders variety. It's about 2 years in the making. The stock breached its longer term uptrend earlier this year, and a break below 48 would resolve this, pattern top to the downside. It would initially count to around $36, then to $21. That's a lot of upside potential for short sellers. If I own the stock, I would use it as a source of funds here. And frankly, I think, if you're going to short the stock, you probably want to use a stop loss of around $52. That would set up an attractive 3-to-1 positive risk skew to our longer term target of 21.
Got it. Jeff, thank you so much. And as always, thank you so much for sharing your thoughts from Alpha Insights. It looks like we're going to wrap up just in time to catch the opening of the market.
Great. It's great to be here.
Thank you for watching, and good luck investing.